This video is going to pick up where the first video left off. So we were talking about if we issued a note that was going to get paid in 2 years and the amount getting paid was $50,000. If we didn't know the value of the equipment, we could calculate the present value of that $50,000 using our required rate of return, that 10%. And then that's how we would value the equipment. And then that discount would end up being charged off to interest expense over the 2 years until that note came due and payable. So here it is showing you it's going into interest expense for those 2 years, and then they pay the note off at the end. Now, if we know the fair value and we know the fair value of the equipment and we know the amount of the note, we can calculate what percentage of interest is actually being charged. Again, I would use my time value money keys. This would be your present value. That would be your future value. You'd have 2 as your N, and you'd compute the IY. Whoops, sorry. We can issue stock in order to acquire assets if the company is willing to take our stock. There will always a market value associated, or there could be a market value. If there is a market value associated with the stock, that is what we will use. So the stock, we're issuing 10,000 shares with a $20 market value. So we're going to value the land at $200,000. Our fixed asset turnover is our net sales divided by our average fixed assets. Average fixed assets is calculated by taking your beginning fixed assets, your ending fixed assets, and dividing by 2. And then it's going to be a times number. I think there's a typo on this slide that has it as dollars. It's not dollars, it's times. So like Gap is turning their fixed assets over 5.43 times, and Ross is turning them over 6.26 times. And that is better. The more often we turn it over, the better. We could trade in an old asset when we purchase another, and then normally there's going to be a difference that we pay in cash. So if that happens, we just have to map it out. What is the book value of the old asset we're trading in? What's the fair value of the new asset? How much cash do we pay? And then if there's a difference, it'll either be a gain or loss. So sometimes it's easiest to just set up the journal entry like they've done here. So we know the old asset, the accumulated depreciation and the cost. We know the cash paid. They tell us that the fair value of the new asset is, $505,000. Are they computing that though? Here. So the old equipment has a fair value of the $75,000 and then the cash that they're giving up. So that's how they calculate that $505,000. So then the difference that we need to make this entry balance is going to be a loss on the exchange of the old assets. Or again, you look at the numbers. The book value is $100,000, fair value is $75,000. We have a loss of $25,000. If we don't have a value, like a fair value that's readily determinable, we're going to take the old assets off of our books and then credit the cash that we paid, and then the equipment would be valued at the old asset we gave up's net book value plus the cash. Now we can construct our own assets like a long-term construction type of a deal. We need to figure out how much overhead we're going to allocate to the project. And then we also need to figure out how much interest we're going to charge to the project. So the overhead, we could allocate it just by if we had our normal overhead costs, did they increase as we took on this project? So what's that difference, that incremental difference? Or we could do a full cost approach to allocate all the costs associated with that job or that project to it. Interest can be capitalized during the period of construction. So it can begin with the first expenditure as long as interest costs are actually being incurred somewhere. So then they give us an example. So if we've made these payments out on this construction of this building. So we've paid our subcontractors, so $1.5 million by the time we get to the end of the year, and then another $900,000 in the first 6 months of the next year. They did get a loan, so they had $1 million construction loan at 8%, but then they also had other interest-bearing debt outstanding at $2 million and $4 million at different rates. But again, debt was outstanding through the whole period. So then we could calculate the weighted average of that debt. So if it's evenly occurred, like it's the exact same amount every month for, 18 months or whatever, or for the 2 years, we could calculate just an easy average. If it's not evenly, it's not the exact same amount, we have to go through down here and calculate our weighted average. So we spent $500,000, and that was outstanding for the whole year. Then another $400,000 was outstanding for 9 months out of the 12, and then $600,000 3 months out of the 12. Then we can allocate those out, and that is, or multiply those out and add them together. That's our weighted average of those expenditures that we would be allowed to calculate interest on. So then we can take the 8% that we're paying on that loan, and then that would give us $76,000 that we could capitalize for that period. Then we can compare what we allocated to what we actually incurred in interest. And again, these are the different loans that we have, and then use the lower amount, because obviously these loans were more than what was necessary to build this project, so they're going to be higher. And again, do that same thing for the following year. So then this is calculating our weighted average rate of all of the debt that we had, because again, think back to the start of the problem, all the debt was at different percentages, and this was our interest rate. So if we divide the total interest that we pay, the interest payments, if we divide those total interest payments divided by the principal of the loans, we can calculate out a weighted average rate and use that. Research and development cost, as I mentioned in the first part of the chapter, those costs need to be expensed. If we're incurring them, it's our employees doing it. Those will all be expensed. So research, again, is we're investigating to discover new knowledge that maybe will help us produce a new product, get a new, like pharmaceutical drug or a new type of an electric car or something like that. Then development is then we're going to take those findings and actually design the new product, and then figure out, work out all the bugs before we can get to the point of actually patenting it and selling it. So these are all costs that could be included in those. So salaries and wages, the equipment and the facilities, any services that are performed by maybe outside experts, and then allocating those indirect costs to whatever part of the building the research and development is, or maybe it's a whole separate building. If we buy the research, that we could set that up. It does say that if it's purchased for a single project, we would expense that immediately. If we buy any type of asset that is used in our research and development department, that we can set up as an asset and then depreciate over its service life. So then this shows you kind of a timeline. So we are just starting to investigate and research, say, a new product, and we're going through all these prototypes and trying to modify that formula or that process or that design. All of those are considered research and development costs. Once we get it to the point where we can patent it and get ready to produce it, that would be more in our commercial production side of things. Then though, that's not going to be R&D costs anymore. So here they give us some dollar amounts with those. So supplies, wages, the equipment, legal patent, legal cost to file that patent, payments to others for services performed. So then the project resulted in a new product that will be manufactured in the following year. The patent was filed. The equipment purchased will be employed in other projects, and depreciation on that equipment was $500,000. So we would charge that off to expense and then put that into accumulated depreciation for that equipment. Then as it goes to the patent, what out of these costs would get charged to the patent? Only those filing and legal costs, that 100,000, because we actually paid for that, to register the patent. But none of those research costs are going to be included in the cost that is associated with that patent. So then what we would have in our expenses for research and development would be all the rest of the costs. So the $19,300, the $14,200 is going to all be recorded as the R&D expense. So the 10 million salaries and wages, the supplies consumed, and then those payments of services. Then they list out that we capitalize the $5 million of equipment, and then we capitalize the legal costs for the patent. Computer software, again, in those IT industries, there's a lot of R&D that goes along with those as well to determine, if it's technologically feasible, if there's a market, if we're going to be able to sell it. So those are going to be similar, that they're going to be expensed as they're incurred, and it's not until we realize that it's going to be a true product that we can sell that we can start to capitalize those. If we perform research and development for others, then we can capitalize those in inventory and then sell them, because it'd be, again, something that the other parties would pay for. Startup costs are organizational costs. So sometimes companies need to train their employees, set up the facilities, and there's a lot of costs involved with that, get attorneys. So all those are going to be expensed in the period that they are incurred. Oh, and then this is purchased. So then if we didn't develop it in-house, but we purchased it from an outside company, then we're going to capitalize that at its fair value and then amortize it out over its useful life. If they're incurred after, if then our own staff then incurs more after we purchase it, those would be expensed. Yeah, and then that just gives you the detail of those startup costs, but again, those are to be expensed as they're incurred as well. So we don't capitalize those as an asset and then amortize those out. So that completes the chapter in those two videos.